Good afternoon, everybody. My name is Thomas Gorman, and I'm the Client Success Coordinator here at the Client Fund. Today, we're going to run through the first of a two-part series in which we explain the basics of two very important financial statements, and that would be the profit and loss and the balance sheet. Um, these financial statements contain vitally important information for every business. It is through these statements that businesses can look at where they have been, they can look at where they are going, and they can make data-driven decisions, um, which are leaps and bounds better than any type of instinctual or gut-driven decision. So this shouldn't take us very long. We're going to work with pretty basic stuff. So to begin, let's just take a look at these two statements. Let's see what they look like. So first, we've got the profit and loss. So profit and loss, if you've never seen one before, um, let's just you could think of a profit and loss as like a budget. Um, Here at the top, we've got our sales, and that's going to be all of the revenue that you have attained through selling products and selling services over the course of the month and the year. Um, Under sales, we have what's called cost of goods sold, or COGS. Cost of goods sold is simply what it costs you to attain the product that you are selling. So in our example here, we are looking at a company that sells t-shirts. So one of the shirts here we can see is a red shirt. And so if you pay $5 for a red shirt and you sell it for $10, the cost of goods sold on that red shirt is $5. It's simply what did it take you to acquire that product? And so that's all of cost of goods sold is. What did it cost you to acquire that product? Now, if you're in a service-based industry, let's just say you're in trucking or you do haircuts or anything that's service-based where you're not selling a product, you're not going to have anything to put in cost of goods sold. So you can just forget about this part of the income statement or the profit and loss statement. And under cost of goods sold, we have our operating expenses, and these are pretty self-explanatory. This is going to contain things like your rent, your advertising expenses, your insurance expenses, uniform expenses, office expenses, supplies expenses. Many different type of expenses can um, are going to go down here. And the types of operating expenses that you're going to have on your profit and loss sheet, they're going to range, they're going to be different from business to business. So even if you have a friend who has the same exact business as you may very well have a different list of operating expenses because every business conducts operations in their own unique way. So you can completely customize this section right here for the things that your business is spending money on over the course of the month. Next, we're going to look at the balance sheet. Now, this is what a balance sheet looks like. Um, there are two main sections on a balance sheet. Um, on the top, we have a company's assets. On the bottom, we have liabilities and equity. So basically, what this is telling us is what assets does the business have and how did they pay for them? So on the top, we're going to see the assets. We've got a bank account, we've got inventory, we've got property, equipment, these type of things, right? Um, and so, the business has them, it's using them to make money. Um, and then when we look at the liabilities and equity section, this is going to tell us, okay, so did the business pay cash for these assets? And does it own them outright? Did they finance it through a finance company? Um, how many more payments do they have? What is the percentage of ownership that they currently have in that asset? These are the things that the balance sheet is going to tell you as a business owner. And it's also going to tell the bank when you go to try to acquire a loan for your business. The bank is going to want to see your balance sheet. And they're going to look it over very carefully. Now, I said we have two different sections. We have assets and then we have liabilities and equity. They can be further broken down into subsections. So current assets are items that can be liquidated fairly easily. So we see in our current assets, we have bank account and inventory. Obviously, those, bank account is pure cash. Inventory is something that you're constantly turning over to produce cash. Long-term assets, property, equipment. These are things that are going to take a little bit longer to turn into cash. Down here, we have current liabilities and we have long-term liabilities. Obviously, something like payroll taxes is going to fall into your current liabilities because that is something you're going to pay off at the end of every month. Long-term liabilities, let's say a mortgage on a property of a piece of equipment, you're going to pay that off over a number of years. So we would put that under long-term liabilities. And then we have the equity section. Now, the equity is basically the percentage of these assets that you own. You don't owe money on them. You own that. You also have retained earnings, which is the amount of money that the company has produced in surplus at the end of the year. So let's hop into it. Let's start with our pre-opening balance sheet. And let me give you a little bit of backstory on this company. Now, as I said, this is a t-shirt company. And the balance sheet, the pre-opening balance sheet is going to show us what the business assets look like on its first day of operations. So in this case, we have a company that, well, let's go to our data section so I can show you. So this company got a $50,000 loan and it has $40,000 from the owner that they have invested in the company. So when we go back over to our pre-opening balance sheet, we can see that $50,000 right here was used to purchase a piece of equipment. So that is going to be, it's a long-term asset because, it's a piece of equipment, but it's also going to become a note payable, a long-term liability, because we still have to generate the revenue to pay back the loan for this piece of equipment. Now, we also said the owner injected $40,000 of his own money into the business. And so with that $40,000, we can see that the owner has put $20,000 in the bank and he's used $20,000 on inventory. So in total assets, the company has $90,000. In total liabilities and equity, the company also has $90,000. So next, we're going to look at the data. Now, this is a list of data that I've compiled that is going to represent the company's revenue and expenses over its first month of operations. So what we need to do is we need to transfer this data onto our profit and loss sheet. So that is going to be the first step. So go back over, take a look at our profit and loss sheet. We'll start at the top. So obviously for the month of January, first thing we've got is red shirts. So let's go back over to our data. Let's take a look at our red shirt data. So we see the price per unit on red shirts is $20. The cost per unit which would represent our cost of goods sold, is $10. So we're doing 100% markup on these shirts. Now, we can also see that in January, we sold 325 units of red shirts. So we now need to get that data onto our profit and loss sheet. So go back over to profit and loss. We're going to go January red shirts. We'll type equals. Go back over to our data sheet. $20 per shirt times $325. And there you have it, $6,500 in revenue from red shirts in the month of January. And now we will simply now we're going to simply repeat this process for the rest of our revenue. So blue shirts, we're going to go equals, go over here to our blue shirt data from January. So we've got $22 per blue shirt. And we're going to go times 400 units sold in the month of January. And there we go, $8,800 of revenue for blue shirts in the month of January. On to green shirts. Once again, here we go. $19 per green shirts times 375, $71.25 in revenue. White shirts equals $18 per shirt times 360 units. There we go. And last but not least, we have brown shirts equals $20 per brown shirt times 355. And there we go. We have the revenue portion of our profit and loss statement filled out for the month of January. So going on down, next we're going to take a look at cost of goods sold. And this is almost going to be step by step the same as we just did for revenue, except instead of using the data for price per unit, now we're going to use our cost per unit to show what did these shirts cost us to buy. So once again, I'm going to start with red shirts equals $10 per unit times 325 units. There we go. Blue shirts, once again, same process, $11 for a blue shirt is what it cost us, times 400 units sold. There we are. Moving on down the line, and go with green shirts equals $9.50 is what each green shirt costs us to purchase. So times 375. There we are. White shirts, $9 per unit times 360 units. Brown shirts equals $10 per unit, what it costs us, times 355 units. And there we go. And so now we can clearly see what our revenue is going to be for the month of January. We see what our cost of goods sold was for the month of January. And that leads us down here to our gross profit for the month of January, $18,002.50. Now, we've yet to deduct all of our other expenses from that. So that doesn't mean we made a profit of $18,002.50. That means we made a gross profit. Now we have to subtract those expenses from that gross profit to see what our net income is going to be. So go back over to our data. We've got our expenses for the month of January right here. Now I've got them broken down into two different categories because I want you guys to understand that there is a difference in the type of expenses. So you can have fixed expenses, and fixed expenses, a good example of that would be rent, right? Your rent is going to be the same thing every month. You can count on it like clockwork. You might have the same thing budgeted out for advertising. You might say, hey, every month I'm going to spend $350 on advertising. Usually your accountant's going to charge you the same thing every month. The um, security software for your building, location, is generally going to be the same. So generally, all of these expenses are going to be fairly constant over the course of the year. Over here on the right side, we have variable expenses. And these expenses change based upon a number of things. So if we say we have a t-shirt company, let's just say this company, prints out the t-shirts and then they mail them out. It's you know, something that depending upon how many units of shirts that you sell, your postage expense is going to be dependent upon that number of units. And that's going to change every month because you're generally going to sell a different amount of units every month. Same thing with supplies and office expense. Utilities expense, the amount of water and the amount of electricity that you're going to use every month always varies. Not very predictable, at least not down to the cent or down to the dollar. The same thing with repairs and maintenance. You never know when something's going to break. Some months you'll have repairs and maintenance, other months you won't. And then you have things like your merchant services card fee. Generally, that's going to be somewhere between 2 to 3% of your overall revenue, but your overall revenue fluctuates from month to month. So again, we see, all of these expenses are variable in one form or another for one reason or another. And so let's head back over to our P&L. So we see rent expense, number one. So we're basically going to do the same thing we just did for revenue and cost of goods sold. So we go equals, we go over to our data, rent, there we go. Advertising equals data, advertising, enter. Your accountant, which I hope you guys are using one, $200, enter. Securities expense equals, enter. Uniform expense equals, enter. Insurance expense equals, enter. And salary expense equals, enter. Now we'll go down to our variable costs and we'll repeat. This is really just an exercise on logging the data in, putting it where it goes, putting it in the appropriate columns. Very repetitive stuff. Once you've done it a couple times, you'll never have to watch a video like this again. But for those of you who have never done it before, having something like this to look at to help you comprehend, what's going on here, can be very, very valuable. So again, postage expense, $500, enter. Supplies expense, $250, enter. Office expense, $95, enter. Now, interest expense. Interest expense, we're going to have to get from, this is basically going to be the interest on the amount that you borrowed at the beginning of your business. So we said that was $50,000, right? So let's go back over to our data here. And we've got the first 5 months of an amortization schedule on a $50,000 loan at 7.75% interest. So the loan starts up here at $50,000. Every month you make a payment part of that payment is interest, part of that payment is principal. So for the month of January, interest expense, that's right here. Now, generally you'll have a statement, or you can log into your account and you can see these amortization schedules. So we'll just go back over to our P&L. Interest expense equals, we'll go over to our data for the month of January. Interest is $322.92. Enter. Utilities expense, $350. Repairs and maintenance expense, $175. And last but not least, we have these card fees, which almost every business incurs these days because so many payments are made by card. We do very little with cash and check anymore. And so on our data, we have that listed at 3%. Well, 3% of what? Well, it's going to be 3% of the overall revenue, the amount of payments that you accepted that were made with a card. So in our example, we're just going to assume that all of our payments that we take are card based. So then we want 3% of our overall revenue. Okay, go back over here. Total sales is $36,005. So that's what we need 3% of. So credit card fees equals, we want to do $36,005 and multiply that by that 3%. And there we go. Credit card fees, $1,080.15. So now if we just take a minute to look at this, we can see some things pretty clearly. This is going to be what the completed profit and loss looks like for the month of January. And so, we can see that we sold $36,005 in shirts. And those shirts cost us $18,002.50. So that leaves us with a gross profit of $18,002.50. But if we go down to operating expenses, there's another piece of data here that most business owners find to be very valuable. If you add up all of these expenses for the month of January, we see that they total $9,323.07. For us, what that means is our break-even point, which is the point at which you cover all your costs and you begin to actually make a profit. That break-even point is going to be $9,323.07. So that's the amount of money that you had to make in January to make a profit, or to break even and begin to make a profit. And that break even point is probably not going to be exactly the same every month, because like we said a little while ago, we have these variable costs that change a little bit from month to month. But if you get a year of financial data under your belt, you can look at your break-even point for every month of the year, and you can take an average of it. And that's going to give you a pretty clear indication of what it's going to take to break even on a month-by-month basis. So that's a very, very valuable piece of data that all business owners need to be aware of. They need to understand what it is, and they need to understand how to implement that data into their decision-making process. So that's it for profit and loss. We're done here. Okay, so if you recall, a few minutes ago, we talked about our pre-opening balance sheet and what things look like on the first day of operations. So now we want to fast forward to the end of the month, and let's see what our balance sheet looks like after the first month of operations. So we'll just go line by line here. We know that we started off with $20,000 in cash. However, that was at the beginning of the month. That number is going to change based upon our income, expenses, etc. So we're going to go equals. We started off with $20,000, right? We're going to add to that because we sold products. So we brought cash in. So if we go back to our profit and loss, we sold $18,002.50 of product. That's what it cost us. So we want to add that back into our cash because we have sold that and converted that inventory that we purchased that before we opened. We sold that inventory. We're converting it back to cash. So that's going to go back into the cash on our balance sheet. But that's not all, because we've also got our profit or our loss that we have to add on to that, because we made a surplus in the month of January of $8,679.43. So we also have to add that in. And there we can see our bank account or our cash account has gone up to $46,681.93. Next, we have inventory. Now, we said over the course of the month, we sold our inventory. We sold $18,002.50 worth of it. So we have to subtract that number from our beginning balance. So we go here, equals beginning balance of inventory minus the total inventory that we sold. And there we go. So we can see, we started with $20,000 in cash, $20,000 in inventory. Cash went up, inventory went down, and our total current assets went up on account of the profit that we made in the month of January. So then the next thing we have to take a look at is our long-term assets. And so we know we have a piece of equipment that we purchased for $50,000. So we still have that piece of equipment. And there we go. So we have $98,679.43 worth of total assets. Now we need to look at our total liabilities. So current liabilities, we have payroll taxes. We have employees, we pay those employees. And so those payments are going to incur payroll taxes. So we'll go equals, and we go over to our data sheet, and we see payroll taxes here are at $1,000. So we add that in because we have to make that payment on those payroll taxes. We've incurred the liability, but we haven't made the payment yet, so it still remains a liability. Now we have our note payable. That note is directly related to the $50,000 piece of equipment that we had. So we borrowed $50,000 to purchase this piece of equipment, right? Now, if we go over here to our amortization schedule for month one, we see that the payment is a total of $1,007.85. $684 went to the principal, $322 went to interest. The principal here is what we are most concerned with. So what we want to do is go over to our balance sheet. say notes payable equals that $50,000. Wrong 50,000. We'll go to this 50,000 minus the principal payment for the month of January. And so we can see now that that principal payment has lowered our overall liability on that piece of equipment from $50,000 to $49,315. So that liability has come down by 1 month. Now, we've also got our owner's equity. Now, remember, we started with $40,000 of owner's equity. But to that, we also need to add that payment that we just subtracted from our liability. So that transfers from our long-term liabilities down to our equity. So we go back over to our data, that payment was $684. Add that, and there we go. And the last thing that we need for our balance sheet here is our retained earnings. Retained earnings is the amount of profit that was made over a certain time period minus the dividends that were paid out to the shareholders. Now, this is a small business. We're not paying any dividends, so our profit therefore becomes our retained earnings. But there's one other little piece that we do need to add into that. Now, if we go over to our profit and loss, scroll down, we see that our net income was $8,679.43. However, if we go over to our data, we still have those payroll taxes of $1,000 that have to be paid, but haven't been paid yet. So we need to subtract that from our net income. So what that is going to look like is we go equals. We go over to our net income, but then from that, we have to subtract these payroll taxes. So then we can see that our balance sheet balances out. And that is the one and only rule that we have on a balance sheet. Assets equals liabilities plus equity. So when we look at our total current assets, we've got $98,679.43. For our total liabilities and equity, we have $98,679.43. So our balance sheet balances, our work is complete. And this is really one of the foundational pieces of information that every business owner needs to have. It's, I operated a business for many years, and I can tell you beyond a shadow of a doubt, there is no way you can keep this stuff straight in your head. You can't do it by feel. You simply have to enter this data, get it down on paper, and look at it. There's so many little details in this stuff that will help you take your business to the next level if you will simply go through this exercise on a monthly basis, take a look at the results, and then, run through those results and look at what kind of things you can take out of that. So the last thing that I have for you guys today is I want to show you where you can find these templates. So we have a profit and loss template and a balance sheet template on our website. So if we go down to our web browser, go over to climbfund.org. This is our home page. So you go up to Client Services and our Business Resource Center. Scroll down about half the page, and right here we have the balance sheet template and the profit and loss template. These are the exact same two templates we just worked with. I've just got them broken up into separate workbooks. So this is everything that you need to get these statements completed. So thank you so much for tuning in today, and we'll see you next time.